Hi there. My name is Dave Keller. I'm the Chief Market Strategist at StockCharts.com here in the United States in Redmond, Washington. It is such a pleasure to speak to you today as part of the 11 Sessions event here in October. I want to say thank you, muito obrigado, to Rafael and the rest of the group there for the invitation to speak to you. My background is in technical analysis and behavioral finance, and I'm excited to share with you a presentation I'm calling Behavioral Finance, Avoiding the Top Investing Mistakes. Muito obrigado pelo convite. Visitei o Brasil in 2007. I don't know how to say that in Portuguese. 2007. Eu amo muito o Brasil. Eu amo café brasileiro, eu amo caipirinhas, eu amo a música brasileira, e eu amo casa de pão de queijo. And that last one, cheese bread, is fantastic. And I had such I was at Bloomberg at the time when I visited Brazil. I visited Rio de Janeiro and Sao Paulo, and traveled around with our sales rep locally there. And I enjoyed the cheese bread so much, I actually bought a couple extra packages and put them in my suit pocket. And between meetings, the whole rest of the day, I was popping them in my mouth. And we found a grocery store here in our local town that actually has frozen cheese bread. They have it in the frozen section, so we buy it. And every once in a while, my wife and I will heat them up and have them with espresso in the afternoon. So I am very hopeful that the next time we do one of these and you invite me, it is in person in Brazil, and I would gladly travel there to be with all of you. I hope you all stay safe and are well down there. Just so you know where I'm at, so I'm in the U.S. I'm in the northwest corner of the United States in Redmond, Washington. So we're in Washington State. It's called the Pacific Northwest, this area. And if you've not been up here before, it's where a lot of the larger companies, actually Boeing, Microsoft, Amazon, many others have headquarters or large operations here in Washington State. We're on the Pacific time zone, so I think 4 hours behind where you're at for most of Brazil, if I remember right. Relatively speaking, Brazil is it's actually a little bit bigger. It's a little 10% bigger than the United States, including Alaska, which surprised me the first time I traveled down there, just the size and the scope of Brazil. I had no idea it was that large relative to the US. And I think most Americans would probably be surprised to learn that as well. Just so you get the sense, I used to live here in Boston. Most of my career has been in the Northeast, in New York and Boston. It's about a 45-hour drive to get from there to where I'm at now in Seattle. My area of the country in the Pacific Northwest is known for having a lot of rain. So we're sort of, even though we're very far north, very close to Canada, it's actually very temperate here. It's actually, the winters don't get very cold. We don't get a lot of snow at all. And the summers don't get too hot. It's sort of a comfortable temperature. I actually had a sweater on a little bit ago here in early September. So overall, it's a very comfortable place to live because we have mountains all around us. So we're also known for having the Cascade Mountains. The Olympic Mountains are all around us, and the Puget Sound, which is this big body of water in the upper left. Vancouver and Victoria, British Columbia, up in Canada, are all part of the same on the same body of water. And we're known for salmon. Salmon is actually incredibly good here. We have a lot of salmon fish, and it's incredibly good. So at some point, I hope you can come visit the Pacific Northwest and enjoy my area of the United States. I'll talk to you a little bit about just my career history, my investment philosophy, and then I'll get to the bulk of the presentation, which really will talk about behavioral biases, how they creep up in your investment process, and then how I think you can, hopefully minimize the impact of behavioral biases using technical analysis. And I'll try to explain that as well as I can. This is my history in visual format. And so basically you can see I started here in 2000, Bloomberg in New York. And I actually grew up in the Midwest. I went to the Ohio State University in Ohio, and then traveled, went to New York and spent the first 2/3 of my career in the Northeast of the U.S. in New York and Boston. So I learned technical analysis in this period. This is when it was the popping of the tech bubble. A lot of technology companies, internet names, which had done incredibly well in the late 1990s, all started to really struggle in the early 2000s. And so I learned about technical analysis when a lot of investors were really struggling to navigate that period in market history. And so I tend to think of charts as being way more helpful in bear market phases for risk management. And I think it's because that's when I was learning to chart. The people that I worked with that successfully invested through that period were the ones that were able to identify the fact that the markets had changed and make sure that they managed their risk effectively and got out of stocks that were no longer working. And those that didn't really struggle through this couple-year period. I then was hired by Fidelity Investments, and I moved up to Boston in 2008 and ran the technical research team and one of the other research departments there, which was a really fascinating experience to be at a place where we're managing a good deal of money. It's just around $2 trillion in assets that we were managing at the time. And it's grown much more since then, to be honest with you. But overall, it was a fascinating experience to think about the markets and to analyze them during that period. I've been involved with the CMT Association, used to be called the MTA for many years. And that's actually how I first met Rafael, who was, I think, invited me to speak here. Rafael attended one of the CMT symposiums up in New York, and I encourage you, once it's safe to do so, I'd love to meet as many of you as can make the trip, because it's a fascinating group of people, really committed market professionals that use charting and technical analysis in their own investments. So I was actually president of the CMT Association from 2010 to 2014. I'm still involved and helping to manage the CMT exams. In 2016, I left Fidelity and I ended up launching my own firm called Sierra Alpha Research, which I still operate today in 2017. Sierra Alpha Research is actually from an aviation term called situational awareness, which we'll talk about later in the presentation. Then stockcharts.com hired me, and I relocated to the Seattle area in 2019. I joined the firm full-time as their chief market strategist, and it has been an absolute pleasure. It's a really great company. It's a small company. We only have about 35 employees all here in Redmond, Washington, but it's a fantastic group of people really committed to empowering investors to make better decisions using charts, and it's a pleasure to be a part of that. Continuing on, so, my investment philosophy very quickly is to just explain that humans are emotional. We are emotional. We are wired to make decisions from an emotional point of view. I was taught that the markets were driven by fear and greed. In bull market phases, it was greed, and that's what caused the prices to keep going higher. In bear market phases, it was fear and people panicking, and that's what causes prices to go down. I would argue that at this point, the markets are driven 100% by fear. On the upside, it's fear of missing out, fear on missing out of the next big move higher. On the downside, it's fear of losing everything, fear of the markets going to zero and just having another climactic loss like we've seen in previous years. So emotion, individual and institutional investors, I think, largely are driven by fear. And so if we can find ways to quantify that fear and to analyze it and manage it, I think, and minimize your own fear as part of your decision-making process, I think you could be in very good shape. I want to talk very quickly. I think people spend way more time worrying about things that they can't control and not enough time on things that they can control. And I'll tell you what, successful investing for me is all about a balance between skill and luck. But if you look at your performance, if your performance looks like this was technology in 2019, just continuing to go higher and higher. The relative strength, this is technology versus the S&P 500 going up and to the right. And if your portfolio looks like that, you tend to attribute that outperformance as due to your own skill. My portfolio is doing well because I'm such a great investor. I make such good decisions. I have a great process, etc. When your portfolio looks more like energy did in 2019, going down, your performance is weak, you're underperforming the market, we tend to blame that on luck. We tend to say the market's just moving against me. It's just a bad run of performance. And it's so funny that we don't do the opposite. We don't, what we want to do is minimize our thinking about luck. Luck is going to have, right? There are times when the market is going to move with us or against us, and we can't control that. What we can control is how we make decisions, what information we consume, who we talk to, who we listen to, how we manage risk, how we think about potential returns. Those are all things we can actually control. And so what I do working with users at Stock Charts and my own clients at Market Misbehavior is encouraging them to focus on what is within their control, their routines, their decisions, and how they manage risk. I would argue that for any investor, no matter what portfolio you're running, if you're running your own investment portfolio, your own retirement account, or you're managing $1 billion portfolio for institutional clients, I would argue you're trying to do three things. Number one, identify trends. This is the semiconductor ETF, ticker SMH. This is back at the sort of midway through 2020. So you can see that it had recently broken above the February 2020 high. You can see the relative strength was very strong. Overall, this is a really good chart. And so identifying that semiconductors were starting to work is a good reason to start to participate in that uptrend. Step two is to follow those trends, to stay with those trends as they continue to work. And if you go through year end 2020, you can see that trend continue to go higher. The stock or the ETF continued to make higher highs and higher lows. And overall, that's very strong. Step three is to anticipate when those trends are exhausted. Identify, look for signals that tells you that the uptrend is no longer in place. And we saw a signal there the first quarter of 2021, January into February, when the price made higher highs. But the RSI, a measure of momentum, actually made lower highs. This is a measure of the strength of the trend. So we can see that the high prices keep getting higher every month, but all of a sudden you have this pattern where the momentum is actually going lower. And what that tells you is it's indicating that there might be an exhaustion of buyers. There is not enough buying power to keep this trend in place. And soon after, semiconductors actually underperformed. This is when a lot of the cyclical sectors, things like industrials and energy and others, materials started to really do well, and technology and others started to struggle a little bit. The FANG stocks and others really struggled over the next couple of months. So that is your three-step process. And I would say if you make it any more complicated than that, you're missing the simple benefits of using charts to identify trends, follow trends, and anticipate when those trends are exhausted. Now, we're going to talk through the remainder of the presentation about a series of behavioral biases. And these are basically ways that academics have determined or have categorized, have made categories of behavioral decision-making, right? How and why you make decisions certain ways. Unfortunately, we are all hardwired to make very poor investment decisions. The good news is we can identify that. We can manage to that. We can try to minimize their impact on our decisions by having a good decision-making process. And what I want to do is share with you some of the behavioral biases. I'll tell you how they creep up in your process and then give you some actionable tools to minimize their impact. So first off is one called narrative bias. And nothing against Bloomberg. I'm a former Bloomberg employee. I think very highly of the company and what they've done. But this was a headline from Bloomberg a couple of years ago. It was in 2017, but the quote, the headline was, "What analysts are saying about the plunge in Hong Kong stocks." Now, it's worth noting that the Hong Kong index at that day was down about 2% at the end of the day. So the fact that we use the verb plunge to describe a 2% loss is kind of laughable. It's kind of unrealistic, right? I mean, it wasn't really plunging. It was a short-term drop, and soon after, the price went back higher. But if you read the description, if you read the content of the article, here's what happened. Basically, they asked a number of different market strategists what caused the sudden drop in Hong Kong stocks. And I will tell you, between 5 different strategists, they came up with about 15 different reasons why the Hong Kong index, the Hang Seng, dropped by 2% that day. So 15 different reasons to describe this one particular event. So a number of funny things happen there. We are so hungry for a narrative. When the market moves, we want to know why. We want to know why a stock went up, why a stock went down, why the indexes went higher, why they went lower. And if you read any financial media or publication, they always attribute a reason. The markets go down because of inflation concerns. The markets went up because of infrastructure spending or the Fed or whatever. And so we are wired, and a lot of that is driven by financial media that wants to attribute everything has to have a reason. In reality, having been in the markets for over 21 years, I will tell you, sometimes the markets just move. Sometimes stocks just go up or go down because that's what happens. There are a lot of different participants doing a lot of different things. Now, sometimes there are absolutely key reasons, right? The Fed makes a big change in policy, the Federal Reserve, there's going to be a move in stocks because of that. And that's absolutely true. But day to day, the short-term movements really are driven very little by a narrative. It's just supply and demand, I would argue, and how it comes out. This happens in a lot of different ways, right? Market X or stock X went down because of why. We all often attribute a reason. That's narrative bias playing out. Often I'm asked in financial media when I'm interviewed on Bloomberg or some other media outlet, what happened today? Why did something go down? And they want to understand what it is. And in the end, it's the net of a lot of different participants, not necessarily one specific narrative. We love to think in the future and think about and simplify by narratives, right? If interest rates go higher, this particular stock should do well because of X, Y, Z. And what you have to remember is that the markets are not that straightforward. They're not that simple, right? It's not just about interest rates and a bank, and that's it, right? These are two things that are happening amongst thousands of different variables that are causing stock prices to fluctuate on any given day, any given week, any given month. So while narratives make us feel better about having control over what's happening in the markets, at the end of the day, I would argue charts give you a much better set of tools to manage that. And so I think the best way to minimize narrative bias is by opening your mind, keeping an open mind as an investor, but also focusing on the charts. A more recent example of that, this is in late sort of 2020 as the markets were recovering. The market were recovering from the coronavirus, the initial coronavirus panic, and then out of the March 2020 low, the S&P continued to go higher, and a new ETF was issued here in June called WFH, the Work From Home ETF. If you look over the next couple months, it really didn't do that well. I mean, it did okay, but it really didn't push that higher. And even though we all were working from home, the idea that an ETF focused on stocks, banking on the fact that people were going to work from home, seemed like the most obvious investment idea in the history of investing. It didn't really work. It did okay. I mean, you didn't lose a lot of money owning this ETF, but you did not perform any better than the broader market. There are plenty of better places to be during this period. I always tell people, should is not a word you should ever use. This ETF should do well because of blah. If you're ever using that word to describe a potential investment, you're assuming way too much about what may happen or what could happen. Focus on what actually is happening. So I would encourage you, I think one of the biggest benefits of social media is you have readily available many, many different narratives. I'm on Twitter, and you can see my handle here. And I'd love for you to follow me on Twitter. And I post a lot of content every day just about the markets and about investor psychology and behavioral biases and so forth. But there's a very good thing about Twitter, which is it encourages a great dialogue. The problem with social media like Twitter or Facebook or even LinkedIn or Instagram or any others is the moment you start hitting like or you put a thumbs up on anything, the algorithms for those social media networks start to curate or start to limit what information you're seeing. And the more that I follow people that are growth-oriented chart technical analysis investors, I'm going to get a steady stream of information that just completes or perpetuates that narrative that I've already come up with, right? So the problem is if you look at social media, you feel like everyone's bullish or something. A lot of times it's not that everyone in the market is bullish. It's everyone in your very narrow area of focus are bullish at that time. So the problem with social media is it limits our ability to think outside of our already preconceived notions. So I would encourage you to actively search new narratives. I think, politically here in the United States, it's a very divided country in terms of our political leanings. I always encourage people to actively look at writings and media outlets and others that are the opposite, take a differing point of view. They take a contrarian point of view to what you think, just to reevaluate your own preconceived notions about a lot of different things. And I think with social media as well, if you're a growth investor, search out value investors. If you're very bullish, actively look for people that are bearish and see what's causing them to differ opinion from yours. It's not easy to do. You have to actually proactively do so, but I'd encourage you to do it. The next bias we'll talk about is called confirmation bias. I think this is one of the most prevalent and sneaky biases. Basically, what we do is we often decide whether we're bullish or bearish, and then we start to gather evidence to confirm what we've already decided. And it happens all the time. I'm bullish on this company, and fundamentally you analyze the company, you think it's good. Then you start looking at the chart, and what you do with the chart or with other information is just try to validate what you've already decided, because you already want to own the stock. You're just trying to come up with more and more reasons to confirm that preconceived decision. What you want to do is completely flip that, right? You want to start by gathering evidence and then look at the weight of the evidence and then determine what you need to do. I spent some time learning to fly airplanes. This is the panel of a Cessna 172R, which is what I spent most of my time learning to fly. And I still have a lot to learn, but I've enjoyed the process of trying to learn how to fly airplanes. And, one of the things that you are taught is to develop your situational awareness. And that is basically having a good awareness of what is happening inside and outside the cockpit. Most airplane accidents, particularly with private pilots, with individual pilots, recreational pilots, is due to human error. Over 90% of accidents are caused by human error. And it's usually things like running out of fuel, flying into clouds, flying into obstacles, losing, track of where the ground is and flying into a mountain or something like that. And that is by far the most common cause of accidents. So what you're taught is to look at your instruments, to trust your instruments, and to always have a good sense of what's happening around you as a pilot. And it's so funny, what we often do with confirmation bias as pilots is you think, I'm going to be okay. I think the plane is fine. I think we're going to be all right. And then you look to try to find information. If you see anything that tells you things are not great, like maybe your fuel's a little low, or maybe you're not in the right position, you mentally try to push that away and just try to feel better about how the conditions are. And what you're trained to do is to do the opposite, to look at the information and then determine whether or not everything is okay. So as investors, we need to do that as well, right? You need to unpack what you're already thinking. Don't think about your current positioning or your current ideas, and just focus on the message that the markets themselves can provide. I have a very consistent process that I call the morning coffee routine. I look at the same set of charts every morning. I have a separate set of charts called my weekly routine, which I do Thursday, Friday, Saturday, Sunday, and Monday. Every day I do the same set of things. And this process has allowed me to stay very comfortable with the trend in the market and identify when things are rotating and make sure I identify new leadership and stocks that are lagging, because I go through the same set of things. It's very difficult for me to be caught off guard in terms of changes, because I'm looking at the same set of charts every day and I watch how they're actually playing out. Now, I'm a technical analyst, so I spend most of my day looking at charts in some way or another. I don't assume that you would maybe have the time to dedicate to all of these different things. These are a couple hundred different charts that I look at every morning. However, you should have a routine, right? My question to you is, when you think of a morning coffee routine, you get your delicious cup of coffee, you sit down in front of the computer, you turn it on. What's the first thing that you look at as an investor in the morning? And if it's something like the current market and how it's changing, or it's your current portfolio, I would argue you're doing it completely backwards. You should look at those things at the end of your process, especially if you're a long-term investor. The first chart that I look at every day is a weekly chart of the S&P that goes back for 5 years. So I'm not looking at all about what's happening today. I'm looking at the long-term trend, because I'm a long-term investor and I work for long-term investors. So I want to primarily think about the long-term trends. And so I start there and then develop my process from there. So I'd encourage you to think about your own process and what steps you're taking. Hindsight bias is a really interesting one, and it's important to have good self-awareness as an investor. I've spent time working with some very successful investors, and I've had the opportunity to meet with successful money managers with my time at Fidelity, but hedge fund managers and traders and others really around the world over my career. And if there's something that I would say is a consistent quality about successful investors and successful traders, is that they have a good self-awareness. They will tell you very clearly what they're good at and what they're not good at. They have a very good sense of both of those. And so I would ask you, the most important thing you can do, how well do you have a good sense of your strengths and your weaknesses? What do you do very well as an investor? What do you think is really consistently positive? What do you think you could do better? How would you think about all the steps that you take it as an investor, and what could you maybe improve a little on? And I found that good investors, good traders find ways to benefit from their strengths. They find ways to take advantage of what they're good at. And they also find ways to minimize the impact of the things that they're not good at. And they surround themselves with people and resources and routines to help address those potential weaknesses. Hindsight bias is this. This is basically the further that things get in the rearview mirror, meaning after something has happened and more time goes by, we tend to think better and better about our performance. And here's what I mean. If you look back at the 2020 peak, so the S&P 500 peaked in February and it bottomed out in March. We're actually looking at a particular stock, Home Depot, which is a home improvement retailer based here in the US in Atlanta, Georgia. And you can see that the stock made a new high in February and then here made a new low in March. Now, as I may have traded that stock, I probably wasn't selling it as it made new highs. That was probably pretty encouraged about it going further and further to the upside, but very soon it started to roll over. And probably when it started to break down through the December low, I probably started to take some of those bets off and think more about risk management because things were going down. And then things bottomed out very quickly. It was a V bottom and it jumped very quickly. So I probably didn't pick the exact bottom But soon after it traded higher, I probably got back in and tried to ride the price higher. But as you think back in, as it gets further and further away in history, we start to optimize. We think much, much better about our performance. We optimize our historical performance in our head. The further it gets away, the more we feel like we actually did really well. We called the top in Home Depot. We got the exact bottom in Home Depot. And again, if you look in social media, if you ask investors, they often overestimate their historical performance because it's called hindsight bias. We tend to overestimate our historical performance over time. One of the great contrarian writers called Humphrey Neal wrote, his quote is, "Don't confuse brains with a bull market." In an uptrend, we all think that we're doing incredibly well. And a lot of times that's just the bull market that's doing well. It's not necessarily our incredible performance. So what do we do about hindsight bias? So I think we need to make time to review performance. So there's two steps to this. Number one, as you're investing, as you're trading, you need to keep a paper list or an electronic list, some way that you are keeping a journal of your trades, a trading journal. I actually do it with pencil and paper. Here's my journal that I keep updated all the time. I have it right here next to my keyboard. I'm always jotting things down. And again, I do some of my own investing, of course, but I also do a lot of work for clients, talking about stocks for stockcharts.com, but also, coaching some of my own investor clients at marketmisbehavior.com. And so I am often, talking about particular stocks. I'm always keeping a log of what we're talking about so I can track their performance over time. And when I was at Fidelity, we used to have a meeting called the worst call meeting. We'd all get in a conference room and we'd say, what was your worst call in the last 6 months? And everyone would have to bring a printout of their worst investment decision. And we would always talk about, what did you learn from that? And what are you going to do differently going forward? So what I would encourage you to do is, with some regularity, every 6 months, every quarter, every year, whatever's the right time for you, look at your benchmark, look at your investable universe. So I'm looking, for me, at the S&P 500, just as a good example universe of stocks that I could buy or sell as a US-based investor. Year-to-date 2021, I think through yesterday's close, the top performing stock is Moderna, up over 300%. This is obviously one of the makers of the COVID-19 vaccine. It's done incredibly well. BBWI is a consumer discretionary stock. Nucor is a materials name. It's a steel company. You have Fortinet, FTNT, and then Generac makes generators. All of these stocks are over 100%, have had a positive 100% return so far year to date. You also have the lowest 5 stocks have all lost more than 20% over that same period. LW, Market Access, is a financial, let's be a market data name. VTRS, a pharmaceutical name. Take-Two is a video game manufacturer. LVS is a gambling stock, Las Vegas Sands. So the question is, do you own any of those top performing stocks year to date? And if so, great. What caused you to pick those stocks? But if you've missed these, what did you miss on the chart of Bed Bath & Beyond or Nucor or Generac that would have caused you to that you miss? What did you miss in this stock that clearly did very well? On the downside, did you own any of these names that are the worst performers? And if so, how did you miss the risk management and the opportunity to sell before the losses were so bad relative to the S&P 500? So I would encourage you to keep a good track of your trades, review those as always, but also look at your universe and see what opportunities you may have missed and where you might have may need to improve your risk management approach. Now, I would say risk management is one of the most important things we can do as an investor. And for me, risk management is all about discipline. As a pilot, you are taught to use a checklist for everything. So literally, when you go to take off, you have a checklist. When you go to land the plane, you have a checklist. If something happens in the middle of a flight, you have a checklist that is designed to minimize problems and make sure that you can land the plane safely. So this is literally part of the pre-flight checklist. Right before you start the propeller, you turn the master switch on, you turn on the emergency beacon, you take the fuel throttle and you open it up just a little bit. You set your fuel air mixture to cutoff level, idle, and then you turn the fuel pump off because you don't, or make sure it's off because you don't need it when you're on the ground. And once everything has checked out okay, then you yell out the window and you start the propeller. And 99% of the time, the propeller starts just fine. For emergencies, you have a similar checklist, right? If your engine cuts out, you have a set of things that you follow, and you go through these steps. So you are taught to check the fuel to air mixture, to check the throttle, to check the key, and you go through these set of steps. And then if that doesn't work and the engine's still out, you have a set of steps to make sure you can land the plane safely. So as an investor, do you have a well-articulated investment checklist, what I would call a technical checklist? This is what my checklist looks like, by the way, for literally every investment decision I've probably ever made. I've either used this checklist or I wish I had used this checklist. First off is Dow theory. Is this stock, is this chart in an uptrend or a downtrend? That is the very first step. And until I can answer that question, I've not earned the right to do anything else. Then I look at trend lines, moving averages, any particular price patterns, key support and resistance levels to determine if there are levels at which I want to pay special attention. Confirmation, which would be things like, indicators like RSI or MACD or something like that. And then relative strength. How is this stock or ETF performing relative to its benchmark? And I need to make sure that I check those 7 boxes, and then I can determine whether I'm bullish or bearish. Now, as I was just getting started, I literally wrote every decision out by hand. And when I've taught technical analysis at the college level here in the United States, I've had students literally write out their answers to those questions to learn the discipline of technical analysis. At this point, I've sort of internalized this checklist and I mentally go through each of those steps, but I don't necessarily need to write them out anymore. My question to you is, do you have a good checklist to make decisions? If not, you are welcome to use mine as a starting point. I would encourage you to tweak it and make it your own, use your own steps. And there could be other pieces of information, fundamental data and so forth that you might include in your own decision-making process, but make sure that you have a checklist to make your investment decisions. I always tell people when they, the time to determine an exit strategy is when things are going well. You don't, as a pilot, you don't wait until the engine cuts out to figure out what you're going to do in that situation. You're trained to already know what to do. So the moment the engine cuts out, you immediately follow the steps. You don't even have to look at them anymore because you have them in your head. You follow the steps, you communicate, you do what you need to do. And, most of the time things work out just fine. So this is one of my solo flights. I actually learned to fly around the Boston area. So this is when I was flying from Rhode Island back to my home airport, which was southwest of Boston. And this is looking off of the right wingtip to Providence, Rhode Island. So this is probably hard to see, but those buildings right there are Providence, Rhode Island. This is Providence Harbor, and off in the distance is Cape Cod, Massachusetts, over there. So I was enjoying the view. I was taking pictures, but what I was also doing was knowing that off the left wingtip, this is an airport called North Central Airport, just a couple of miles off my left wingtip. And I knew that if my engine would go out right at that moment, I knew given my altitude and my airspeed that I could land safely at this airport. I knew what runway I would need to go to. I knew how to communicate with the other pilots in the area, and I'd already had a plan in place. I didn't need to use it on that day. Everything was fine, and I progressed through the flight okay. But what you're taught as a pilot is when things are good, when everything is good, that's when to think about your exit strategy. So right now, your portfolio may be doing just fine. I think a lot of investors based in the US feel pretty good about their performance because the average stock has been doing pretty well. The markets themselves are going up consistently, making higher highs and higher lows. So I tell people, now is the time to be thinking about your exit strategy. Don't wait for the stock to start coming down to start to think about what you would want to do in that situation. So a great transition here into my current market outlook, because I think the S&P 500 overall is still in a consistent uptrend, making higher highs and higher lows. But I think, as I mentioned in the previous slide, now is the time to be thinking about your exit strategy and think about what you would need to see in your benchmark, in your portfolio, to start to think about, rotating away and rotating into other things and getting more defensive. For me, I think there's 3 things to keep in mind for the S&P 500, right? And overall, I would say, the market has been very, very strong, and the U.S. continues to outperform non-U.S. markets, broadly speaking. So for U.S.-based investors, it still makes sense, generally speaking, to be in the U.S., although there are some non-U.S. markets that are starting to improve. And if the dollar would change and weaken significantly relative to what it's been doing, that could certainly change the picture. But for now, overall, the U.S. market has been very, very strong. So, we've made higher highs and higher lows. We've had very few corrections of any material. We've only gone down 4 to 5% on average on any pullbacks year to date, which means for a lot of us investors and strategists, we are pretty sure that there is going to be a correction of a more significant nature at some point before the end of the year. Three things that I would be looking for on this chart. Number one, make a lower high. So we've made higher highs every month year to date in 2021. At some point, we will stop making higher highs. We will make a lower high. And that will be the first indication potentially that the uptrend is no longer going up. Number two, breaking below the 50-day moving average. And the S&P 500 has pulled down to its 50-day moving average 7 or 8 times so far in 2021. Every single time, the market's turned right back higher and closed above it the next day and has pushed higher and made new highs soon after. So at some point, the S&P goes down through its 50-day moving average and follows through. And that would be an indication that things are starting to get a little more negative. We've not seen that yet. The third step would be making a new swing low. So an uptrend is higher highs and higher lows. A downtrend is lower highs and lower lows. So making a lower low, going below the most recent swing low, which is around 43.60, that would tell me that the trend is starting to turn. So until we see those three things, a lower high, a lower low with the S&P below 43.60, and breaking below the 50-day moving average and staying there, until those three things happen, the trend is positive, and I still think you can think risk on in terms of overall positioning. Now, there are some concerning patterns underneath the hood, or below the next level, below the market. And I would say breadth conditions overall have been deteriorating over the course of the year. I've talked with my own clients about the market being in a stealth correction since May. That's when things really started to change. If you look at the percent of stocks above their 50-day moving average, it was over 90% back here in April. It's now 60-70%, which is quite a bit less. Right now, if you look at the percent of stocks in the S&P 500 above their 200-day moving average, it's currently around 76%. Earlier in April, it was almost 100%. Almost every stock in the S&P 500 was above its 200-day moving average. Now it's down to around 76%. Over the last couple months, the market has been going higher, but the trend in stocks above their 200-day moving average has actually been going down. So that tells you that a lot of stocks are actually breaking down. Even though the indexes are going higher, stocks are actually starting to break lower. And I think that's a cause for a bit of a concern. So what do you do in this environment? Well, I think regardless of the overall market environment, again, until you see those negative signs on the S&P 500 chart, I think overall the trend is still very much positive for the long-term investor. But I would say in general, there are 3 buckets of stocks that I start to look for, and I'm not struggling to find examples of these right now. I think the first bucket are stocks that are consistently making new highs. In the US, you're finding a lot of that in sectors like healthcare, consumer, communication services, but especially in technology. And so this is a stock called Gartner Group, ticker IT, which is a 27 billion US market cap stock. You can see that the trend overall has been very positive, consistently beating earnings. It's above 2 upward sloping moving averages, and the relative strength has been very strong for the last 8 or 9 months. Those types of charts, I would argue, I would never have a problem of having a portfolio with that type of chart in the portfolio, because those are stocks that are just working. They're consistently working. So I'm often looking at the new highs list to find stocks that are in consistent uptrend. So there are a number of stocks in technology in particular that look very similar to this chart. The second type of chart that I'm interested in are stocks making a rotation from a distribution phase to an accumulation phase. And First Solar, FSLR, is one of the solar companies here in the US. You can see it rotated lower, what I'd call a pattern of distribution in January through May. And then you can see it reverts higher, and now it's starting to turn higher, making new highs, making higher lows. And this is now making a rotation from a distribution phase to an accumulation phase. Regeneron, REGN, is a biotech stock that has had a similar pattern to this, and many others. So I think there are a number of stocks that have had this rotation. Even though the market is starting to potentially top out, you're finding stocks that are starting to rotate higher. And I would never have a problem with those types of names. And I think the third bucket would be stocks that are high dividend payers. There's a notable absence of yield opportunities or income opportunities for investors because rates remain so low. So a stock like Altria Group, MO, pays a really strong dividend. It's over 6% dividend yield right now. And so it's, paying a strong dividend. The chart is actually holding up okay. So it's a decent chart, but the dividend component is pretty good. So in a market pullback, stocks like this will tend to hold up okay. Consumer staples tends to do better in a bear market phase, and it's paying a pretty good dividend. So looking in sectors like consumer staples, utilities, and real estate for stocks that are paying good dividends, I think always makes a good sense. So those are the 3 areas of opportunity where I would probably be focused as an investor. We're out of time. This has been such a pleasure to present to you. I hope you found this to be time well spent. I'm so thankful for the invitation to speak for you for the 11 Sessions event this month. You can find more information about me and my work on YouTube. My channel is called Market Misbehavior. I'd love for you to subscribe to my channel and watch videos. I record videos like talking about market behavior and investor psychology often. My show is on Stock Charts TV at 4 o'clock Eastern every weekday. I'd encourage you to go to stockchartstv.com to follow that. And if you can see the tickers on this last slide, you have my final message, which is thank you. Muito, muito obrigado for the opportunity to speak to you today. I wish you all well. I hope you stay safe and navigate this uncertain period okay down there in Brazil. I know we're all struggling to manage things, but wish you well. And thank you again for the kind invitation. Bye now. Take care.
Há 6 anos, nascemos com um sonho: ser a fonte de conhecimento de todos os investidores do Brasil. Sejam eles grandes, médios ou pequenos. Para nós, todos têm o direito à informação de qualidade. Toda manhã, acordamos apaixonados pelo desafio de entender, explicar e prever os movimentos do mercado. Somos reconhecidos como a melhor casa de análise financeira do Brasil. Somos uma central de informação independente, imparcial e livre. Não compramos ações nem vendemos, nem sequer ganhamos comissão de nossos clientes. Sabe por quê? Porque é a única forma de ser independente. Quando o mercado grita invista, 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 nós gritamos, antes de investir, conheça, conheça, conheça. E aqui na Eleven temos qualidade na informação. Temos respeito por todos os brasileiros que poupam seu dinheiro com esforço. Temos a vontade de ajudar os investidores a discernir e poder falar de igual para igual com seu assessor. Queremos criar investidores livres, que tomem as rédeas de seus investimentos, que tenham liberdade de pensamento e autonomia. Nós somos a bússola do mercado de investimentos. E agora chegou a hora de cumprir nosso propósito como empresa: democratizar as informações para todos os investidores do nosso país. As mesmas análises que os grandes investidores têm acesso, agora podem estar nas suas mãos. Pronto para ser independente? Seja bem-vindo à Eleven.